With global environmental issues rising every day, the concept of ESG investing has increased in importance. Basically, ESG stands for environmental, social, and governance. It's the factors investors look towards beyond the financials to decide whether they're going to invest in a company or not invest. Now, ESG metrics are not commonly part of mandatory financial reporting required by the SEC and other organizations, but companies are increasingly making disclosures in annual reports or in standalone sustainability reports to make it easier for investors to make a decision on their investment. ESG investing has only increased in demand in recent years. According to one report, US assets under management using ESG strategies grew to $17.1 trillion at the beginning of 2020, which is a substantial increase from $12 trillion at the beginning of 2018. Now, the coronavirus pandemic has only intensified these discussions around the interconnectedness of sustainability in the financial system. So since the beginning of 2020, I wouldn't even be surprised if that number has shot up dramatically again. So basically, ESG investing is putting money in companies that look after the environment, look after their workers and the society around them, and have a good corporate governance structure. It sort of makes sense. Putting your money in companies that cater to all these things simply become well-run companies, and well-run companies are good stocks to own because they go up in value. So to break down the acronym a little bit more, ESG is environmental, social, and governance. Environmental factors, that is to do with the natural world, so climate change, carbon emissions, air and water pollution, energy efficiency, all those things are considered. Social factors are anything to do with people and the relationships that the company has with the outside world. So, for example, customer satisfaction, data protection, gender diversity, human rights, labor standards, and then finally governance. That's how the company is run. All those things are considered. So board composition, bribery, corruption, lobbying, political contributions. Those things are what are looked at to form this number that is the ESG score. There is a misconception that investing responsibly means foregoing large profits, and I wanted to make a point that is not the case, and I'll show you an example. This is the Just US Index, or GULCD. That's the blue line. It's an index that tracks the performance of large public companies with good ESG scores. And the red line is the Russell 1000 Index, which tracks the largest 1,000 companies in the US by market cap. You can see that the blue line is outperforming the red line, not night and day. It's not a huge difference, but it is good to know that investing responsibly can get you the same, if not better, returns than the market. I hate reading out numbers in a video because they just tend to go over my head, but I think it's important because they're large. So according to one report, solid ESG practices resulted in better operational performances for 88% of companies. The stock price performance of 80% of companies was positively influenced by good sustainability practices, and the cost of capital was lowered for 90% of companies with good ESG scores. That speaks for itself. Obviously just one report, but I think that's where things are tending to go. As I say though, it should be very clear why strong ESG companies perform better overall. If a company looks after their staff, then their staff are going to work harder for the company. You know, one thing leads to another. So if you're an investor, how do you find good, solid ESG companies? The best free resource I know of is provided by S&P Global. And then the best paid resource would be the Bloomberg Terminal, but that does cost like $2,000 a month. So I'll let you decide which one you want to use. I've used both, and to be honest, the free one provided by S&P Global is perfectly fine. Very user-friendly, and it gives you plenty of data. Just type in what company you want to look for, and it'll give you a score out of 100 plus a bunch of other data. The other alternative is to put your money into an ESG Etf who will invest on your behalf, and you don't have to worry about a thing. They're traded on most stock exchanges. One example is the Vanguard ESG ETF, ticker symbol ESGV. God, that was a mouthful. It was only created 3 years ago, but in that time it has outperformed the S&P 500 by over 3 percentage points annually. Obviously, past results don't guarantee future results, and that is one very specific example, but it does show the power of ESG investing. My personal opinion is the gap will only continue to widen between the returns of strong and weak ESG companies. This will be caused in part by the fact information is instantly shareable and is only becoming more widely consumed. Companies can no longer just get away with things and sweep it under the rug, and that has to be a good thing, right?